The fear of losing your hard-earned savings is quite daunting, isn't it? But fear no more. Today, we've got a special treat for you. We'll be journeying through the expert strategies to help you navigate these crazy economic tides. Join us as we reveal invaluable insights from the great author, investor, and shrewd businessman, Robert Kiyosaki, to secure your financial future in these unpredictable times. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. The economic context. Navigating through the latter part of 2023 feels a lot like trying to sail through a storm, given that we're seeing the most substantial economic turbulence since World War II. The world's economy is wavering, and people are scrambling, looking for answers to one crucial question. How do we weather this downturn? Enter Robert Kiyosaki. This renowned author and investor steps into the stage with a plethora of insights into this financial dilemma. He zooms in on the pulse of the financial world, the banking sector, and, more specifically, central banks such as the U.S. Federal Reserve, or the Fed, which he sees as crucial players in this unfolding drama. The Fed, if you're not familiar, is like the puppet master of the U.S. economy. It sets the federal funds rate, which is essentially the interest rate that banks charge each other for overnight loans. This rate indirectly influences virtually every other interest rate, from mortgages to credit cards, thereby impacting the entire economy. And recently, this puppet master pulled a significant string. It bumped up the federal funds rate by 25 basis points, pushing borrowing rates to a level we haven't seen since 2007. This change may sound minor, but it sets off a ripple effect that touches every corner of the financial world. From equities and bonds to real estate and the US dollar, everything feels the impact. Even the puzzling world of the derivatives market, where contracts are bought and sold based on the expected future price changes of underlying assets, isn't immune to these waves. Kiyosaki, however, isn't a fan of this move by the Fed. He's been openly critical of it. In his eyes, these interest rate hikes are not just minor ripples. They're a tidal wave that could trigger a financial disaster. In what might feel like a plot twist, Kiyosaki's grim predictions weren't just scare tactics. They became a reality when Signature Bank, Silicon Bank, and Silvergate Bank, major players in the financial world, fell like dominoes in quick succession. This series of collapses validated Kiyosaki's concerns and reinforced the need for careful navigation in these turbulent financial waters. Impact of central banks and consumer markets. Central banks play a vital role in our economies, with big names like the U.S. Federal Reserve or Fed, the Bank of Japan, and the European Central Bank holding the reins. According to financial guru Robert Kiyosaki, however, these institutions primarily exist to protect their fellow banks, rather than look out for you and me, the average folks just trying to get by. Kiyosaki doesn't hold back in his critique. Remember when President Joe Biden and others, like former UN Ambassador Nikki Haley, stated that bailing out struggling banks wouldn't cost taxpayers a dime? Kiyosaki disagrees. He argues that when the Fed creates what he calls fake money to save these banks, it's essentially setting the stage for a future of hyperinflation. And with the ongoing financial crisis, these concerns are no longer hypothetical. They're becoming our reality. Even though recent figures show inflation slowing down, the pressure on prices is expected to ramp up because of the crisis. A significant driver of this is the housing market, which continues to run hot despite the overall decrease in consumer inflation. Let's take a moment to understand this. The housing market is a bit like a stove. When it's hot, it drives up the overall heat in the room, or in this case, the inflation in the economy. But even when the rest of the room starts cooling down, if the stove keeps getting hotter, you're still in for an uncomfortably warm situation. We're seeing the fallout of this right now with the instability in our local banking sector. Just take the recent closures of Silicon Valley Bank and Signature Bank as examples. The heat from the housing market and the other pressures on the economy are putting these banks in a difficult spot. Now, a lot of people are calling for a pause on further interest rate hikes. They hope that slowing down the increases could help other banks avoid the same fate as Silicon Valley Bank and Signature Bank and bring some stability back into the industry. The effects on you. Alright, let's get this straight. How do all these financial ups and downs affect you? You know, the average person just trying to earn their bread, save up, and maybe even get a little ahead? Let's break it down. First off, remember that the Federal Reserve's rate, the big scary Fed we keep hearing about, has a direct impact on your savings accounts and certificates of deposit or CDs. Now, higher rates can be a good thing for you as a saver. It's like a magnet that draws in more deposits, and in return, you get more profits on your savings. Think of it as a bigger reward for being financially disciplined. Second, let's talk about homes and mortgages. When these rates start climbing, it can drive up the cost of mortgages. So, for those of you thinking about buying a house, you might want to act faster and lock in a fixed rate on your new home. It's like when you see a good deal at a store. You grab it before the price goes back up, right? Next up, bonds and stocks. We all know that the cost of bonds can drop when interest rates are low, which doesn't make them look so good to new investors. It's a bit like seeing a cake in a shop window, but when you walk in, you find out it's day old. Not as appealing, right? Lastly, let's talk about your credit card. When the federal funds rate goes up, the interest rates on credit cards usually follow. It's as if everything you buy with that credit card suddenly got a little bit more expensive. It's a sneaky way your costs can go up without you even noticing. What can you do? Alright folks, let's dive deeper into our current financial situation and explore some strategies to not just safeguard, but also expand your wealth. This stuff is really important, so make sure you're paying close attention. First off, think about short-term bonds. Yes, bonds. I know what you're thinking. As rates go up, bond yields go down, and that makes them a less attractive prospect for new investors. But if you're already holding onto some, it's a safer bet to keep them. It's kind of like having a safety net during these uncertain times. Next, let's talk about where you live. Is it your own home or rented place? If you own a home, now might be a good time to lock in your mortgage rate before it goes any higher. If you've got a good credit score and the conditions are right, consider refinancing. It's like catching a good wave just at the right time. Moving on to debt. That big, scary word no one wants to hear, but we all have to deal with. Now, as interest rates rise, the variable interest on your debts will also go up. You don't want to be caught in that storm, so try to pay off your debts as much as you can. It's like cleaning out your garage. It's hard work, but man, it feels good when it's done. Lastly, don't forget about the old faithful, gold and silver. These precious metals have been through it all and still held their own. They're like the tough old grandparent of the investment world. When everything else is going haywire, they stay steady. So consider putting some of your investments into these inflation-hedged assets. The best way to protect your finances in this economic climate is to diversify your assets and invest wisely. Remember, money needs to work for you, not the other way around. Investing in assets with increasing value and cash flow over time can significantly increase your net worth. We're wrapping up for today, but we hope you've learned something useful. If you did, make sure you click on that subscribe button and turn on your notifications. The more you know, the better you'll be at taking care of your money. Thanks for watching Financial Intellect, and we can't wait to see you in our next video. Stay smart with your money, folks!